Okay, welcome everyone. My name is Adam Weston. Welcome to the Defining Wealth for a New Generation webinar. I'm CMO of Invest. I've spent 20 years as an agency owner working across financial services for companies like Momentum, Quilter, and Quintet Private Bank. Theo, over to you.
Hello, good morning, everyone. My name is Theo Paraskevopoulos, and I'm Chief Executive at Invest. I'm also the product strategist. My career started about 20 years ago as well in the city of London. I've worked with fintech and financial services ever since. And if there has been one constant thing, it has been the frenetic speed of change. So we built Invest to design a product that helps investors and investment professionals talk to each other and stay in control. And in the process, we also developed this survey that kind of gives us a bit of an insight of how investors might be thinking. And this is what I'm looking forward to speaking about today.
Great stuff. Thanks, Theo. So look, the objectives for this webinar are threefold. We're going to discuss the key findings from the 2024 Client Engagement Survey. We're going to explore how younger generations perceive and engage with wealth management. And we're going to highlight the challenges and opportunities for wealth managers engaging these demographics. The webinar is 45 minutes. 30 minutes will be spent focusing on the survey results. So plug in your headphones and have a listen. And I'm sure you've got lots of things going on. But we have some points within the webinar to sort of engage with you. And then we're going to have 15 minutes at the end for an audience Q&A. The survey link will be available in the chat, and we'll also invite you to sign up to a personalized demo of Invest platform. Please use the chat to ask questions, and we'll pick them up at the end. So about the survey, Invest partnered with YouGov to conduct a client engagement survey. In early March, we polled 2,068 UK adults, and we polled them on these 5 points, really: their comfort level with investing, saving habits, methods of tracking investments, feelings about their financial future, and plans to seek professional investment advice in the next 5 years. All responses were anonymous, and the survey results provided really great insights into how Gen X, Z, and millennials approach investing and money management. Before we get going, we'll start with a quick icebreaker poll. So I think in the chat, Paulina has put a poll in the chat, and you'll get instant feedback, and maybe we'll review the results at the end in the Q&A. So let's go. Theo, I suppose survey insights. So our survey found, Theo, that 42% of younger investors are uncomfortable with basic investing principles. What are the main factors contributing to the discomfort among the younger generation? What are your thoughts?
Yeah, in one phrase, really, you can summarize this as a problematically low financial literacy. And that starts families, it continues at school, it's in the media. And here's the thing that's really worrying me is that there is a lot of conversation going on about one part of finance, which is debt. So things like, taking a personal loan, credit cards, mortgages, these are parts of everyday language. Payments as well. You have your Apple Pay, your Google Pay, you have got cards, all sorts of ways to transact. But you don't have the same level of language and awareness when it comes to investing. Things like bonds, basic kind of stock market language, ETFs, things like that. They're not part of our everyday language. And it's just indicative of why people might not be feeling comfortable with investing. Now, there is something with investing as well that is very specific compared to the rest of financial services, which is uncertainty. Whereas with a loan or a mortgage, you draw down, you pay it off at the end, there is a plan for it. With investment, you're kind of talking about uncertainty, about performance, and about how it might impact wealth building that is not guaranteed. And that's harder to talk about. All the more so that we need to help younger people get more comfortable with speaking about these terms, with being able to plan their future. And in some ways, it is about having a lot of choice, but not enough advice. It's about the advice sometimes not being relevant enough. And in my mind, Adam, both you and I are fathers of teenagers. It is also in part with career orientation. This is another one of those problematic areas where there is a lot of data out there, but you can find advice lacking. And when younger people, when they embark on this journey, that's going to last them a lifetime, they might not have enough access to professional advice that kind of like that will help them make the right decisions at the outset.
But where does this come from, Theo? Is this sort of financial education within our educational systems, or do we prioritize financial literacy coming straight down the line from wealth managers? I mean, what's your take on that?
I'd say that it starts in things like the family and the schools and the media. I think that this is where we'd all start as a society rather than a specific company's effort. I mean, there is quite a lot of education going out from the industry, as you would expect. But unless somebody knows where to look because they have got that foundational financial and investment literacy, they're not going to go straight over to an investment manager's or a wealth manager's website and look for the more specialized stuff. I think we need to start with the basics. Compound interest. What does interest rates mean for me? What's the difference between saving and investment? When should I be looking one or the other? It's just really foundational stuff.
Do you think that this is, the numbers that we've got in the survey? Do you think that the lack of financial literacy is sort of paralyzing younger generations, unable to take action?
I would say paralyzing. I'd say that that's a little strong.
Yeah, it's quite
would,
strong.
however, say that is, I say that's stopping them from making the first step. Yeah, I think it's kind of like it stops them from treating wealth accumulation, wealth building, investments as a priority. Yeah, they have got like a million other things to take care of as a young person, either having fun, education, later on starting a family. There are a million things. And investments, just because of low financial literacy, investment just doesn't make the priorities.
Okay, that's great. Thanks, Theo. So I'll move on. So we found that 47% of Gen Z, X and millennials typically save nothing or invest less than 5% of their monthly income. So Theo, question to you. What does this tell us about the financial habits of younger generations, and what implications might this have for their long-term financial well-being?
Yeah. Well, it is typical for somebody entering their investment journey, the life journey, if you like. They go through a cycle. It's a fairly typical cycle. First of all, when you're young, you tend to spend a lot. You tend to spend on your education, on travel, on going out and having fun. It's understandable. Then you go into a period of accumulation, where you start accumulating wealth, and then you go into a period of preservation, where you make sure you don't make losses, so that you go over to what we sometimes euphemistically call a distribution phase, where you're talking about legacy, inheritance, using your savings or your wealth for your retirement, etc. And the issue here, when younger investors tell us this, is that as they go from the first phase to the second one, from the spending to the accumulation stage, and then over to the preservation phase, they're not accumulating enough, and they're not starting early enough. They're not comfortable enough with it. They're not making the right simple decisions. We're not talking about picking stock here, right? We're not talking about the advanced portfolio modeling stuff. We're talking about simple stuff like saving enough money and then moving over from having enough of a savings pot to feel secure about your immediate needs, and then taking the excess to invest it so that you can then go over to wealth building. And of course, that can lead to a generation that grows up to be poorer than the parents. And that can have all sorts of issues.
Okay, so this seems like it's feeding. Yep. Sorry, Theo, it seems like this is feeding back into what we were just saying. I mean, what do we do about this?
What do we do about this? Well, as an industry, the education bit is one thing. The other thing is about proving value. Yeah, it's about talking to younger investors in their language, in the language that is relevant and appropriate to them, and just telling them, you have got all the tools to save, and then there is a journey past that over to investing, and you should be starting as quickly as possible. It's a difficult point to make. Younger investors, as I said, they're in the beginning of the cycle, but there is lots that we can do. We can make it simpler. we can make it more visible, we can talk it in in value terms, we can make it more relevant.
So sort of developing strategies to encourage better saving and investing habits, I suppose, is what you're saying.
But not just leaving it to the apps, not just leaving it to the mobile phones, as a lot of the industry has been doing, which is just to rely on DIY investments, or to the banking industry to kind of to be the only channel, the only way that you can get into investment, but to actually do it as an industry, to not just focus on the older generation, because that's where the wealth and the assets are now, but also to make sure that our language develops and we can work with younger generations.
Okay, and I suppose that has a big impact for the sort of the wealth transfer from older generations to Gen X over the next few years.
Absolutely.
Okay.
This is the point in time where we as an industry need to be able to talk to younger generations, not just because for the societal benefits, but because of self-interest, because there is a wall of money coming our way, and we want most of it.
Yeah, okay, that's great. The survey revealed that 61% of Gen X, Z, and millennials do not actively monitor their investments. What does this high percentage tell us about the level of engagement that and financial literacy among the younger generation, and also what challenges does this present for wealth managers? So it's sort of twofold there.
It is, yeah. I mean, first of all, it confirms the point about being comfortable. If you're not comfortable in a particular situation, you're not going to be engaged with it. You're going to find all sorts of excuses. So even if you do have investments, you're not monitoring them, is what they're telling us. First of all, it's important to say that we're trying to strike a balance here. On one hand, you want people to be engaged with their investments and to monitor it on a relatively frequent basis. On the other hand, you don't want it to be so intense that you kind of think that people are stressed about it, or they're kind of moving towards speculation, the whole DIY model. We're an industry that provides financial advice, a plan, an investment and wealth building plan, and you want to stick to it for the long term. Yes, you want to be engaged, but not so hot on it that kind of looks like you're almost gambling with it. So that is one point. But if people are not engaging at all, of course, it's a completely different problem. And it is a sign that things might be getting worse, that comfort level that is lacking for younger investors is not there. It's almost like they're sticking their head in the sand. Maybe I'll get a pension with my from my employer, and then I'm just not going to look at it, not going to care at all, because I don't understand this world, and I just want it to go away. We have to build on that, because it is the more comfortable you are, the more you monitor it, it kind of feeds into each other.
Okay. And what are the challenges for sort of wealth managers here? So, I mean, we talked about the education gap. So, the importance of regular investment monitoring and sort of active financial management, and how that can encourage younger generation. Bear in mind, we're talking about Gen X, Z, and millennials. So, Gen X aren't that young anymore, are they really?
I'm pretty young. I don't know about you.
Well, I'm pretty young too, I suppose. And then, what other things are we talking about? Sort of technology integration, leveraging digital tools? Are we talking about, encouraging more meaningful interactions and higher engagement? What sort of things are we talking about in terms of meeting, or wealth managers meeting these challenges of the generations not actively monitoring their investments?
So clearly, we're not talking about using, if you should use technology for that. I mean, by now it is clear that, technology is a given, is a benchmark. So we are talking about how you should use technology. And there is a paradigm, or an example over here, is the transition that the banking industry made with technology, where it used to be branches. You'd walk into a branch, you'd cash, checks to cash, and the rest of it, all these archaic instruments. And then the industry transitioned to a fully digital model. Now, that's a journey, right? It's not going to happen from one day to another for wealth and investment managers, but it is a journey that we need to take and we need to accelerate. And in the process, that is going to also help younger investors engage more with their investment. When something is, or there is an experience-driven tool on your mobile phone where it speaks your language, that is both professional looking and relevant without being, how do I put this, condescending or trying to look, like a consumer app. If it looks the part, it will be trusted and it will help drive engagement up.
Okay, so that's great. So I've got an audience reflection point, which is something new that we're trying, and it's basically sort of raising a question and asking a question to the audience, not necessarily for response, but just to think about and muse upon, and then maybe help it form one of the questions at the end of the session. So the reflection point, the first one, is how can you develop strategies to increase engagement and improve financial literacy among younger generations and your clients. So just to muse on that, think about it, and we'll move on to the next point, I suppose. The survey revealed that 51%, Theo, of those surveyed feel they have little or no control over their finances for the next 5 years. So my question to you is, what does this tell us about younger generations' financial outlook, and how might this impact wealth managers?
For me, this is by far the most worrisome statistic to come out of the survey. Having no control when you have so much choice, it does not, paint a nice picture. It is consistent with the overall picture we get. Just over a half of everybody surveyed in some way is not comfortable with some aspect or all the aspects of wealth building, but it should distill a sense of urgency into the industry, because if people have got no control, or they feel that they have got no control, it means that they don't know where to start. And that is worrisome, especially when you've got so much choice. If you open your bank app by now, I have got about 5 or 6 banking apps on my phone. All of them by now offer me an avenue into investing. In theory, there's all these wonderful tools for me to kind of just say, I can control my financial future because I do my savings and I go into investment and I have got these ways to go in there. But if you feel that you've got no control when so much choice is available, it means that the choice is not serving you. It's not serving you as a avenue into the world of investments. In fact, it might be confusing you and stopping you. And this is where, and we'll get to it later on, I'm sure, this is where professional financial advice has got an edge over banking or over DIY apps, over kind of your own broker apps, these things. This is where now is the time for the wealth management and the financial advice industry to shine, to show its value to younger investors.
And to do sort of like short-term financial goals, could that be helpful? Because we're thinking in terms of decades for really young investors, millennials. Maybe that feels, I mean, it's speculation on my point, but maybe that feels something so far in the future that they're thinking more about short-term gains and dipping their toe with investment beyond their pensions.
Indeed, absolutely. And that's how you get into, that's your nudge, if you like, your first signal of starting this. So you have got a short-term plan, a holiday, a purchase, a deposit for a house, a car you want to buy, all these things. So first you start with short-term goals for which you save, and there is a lot of saving products out there. Then you start getting into more medium-term goals like university fees, or as your family grows up, etc. And then you get into the really long-term goals, which is where the wealth industry needs to help you. So yes, absolutely, the longevity of the goals and is what the industry should be using to, as I said, to kind of make things more relevant. It depends on the age group that you're targeting. We're just not doing a great job of targeting the younger generations.
Yeah, I mean, just as a caveat, the survey, spans XZ and millennials, so that's quite a wide audience in terms of age groups. But nevertheless, all the data's come back and feels pretty tight in terms of what we're allowed as an organisation, and the and YouGov collecting that data allowed to disseminate and share with everyone. So look, the survey found that 56% of younger generations are unlikely to seek investment advice in the next 5 years. Why do you think that's the case, and what can wealth managers do to address this reluctance?
I just think we need to take the three challenges head on, and I'm going to be blunt here and just say that there is three of them. They don't know about us, they're scared of us, and they think we're too expensive. Those three. First of all, awareness. You have got all these technology on your phone, on your laptop, whatever it is, and yet you might not know that professional advice, wealth management might exist at your price level. You might think it's something for something we call high net worth individuals, whatever that means, or whatever high is high, but that professional advice is available to you. So we need to work on awareness. The second one is about the language that we use. If we as an industry continue to present our services in such a data-driven way or data-only way, such a scary way, right? We alienate people, especially younger generations that, as we have already talked about, they have got low financial literacy. They have not developed that language. So going to talk about, performance and asset allocation and portfolio modeling at the outset, there's no way younger people are going to engage. And the third one is cost. On that, even if somebody goes through the journey, they engage a wealth manager, attempting to charge them 1% or more of their assets to manage their portfolio, that's not going to be in line. That is simply not competitive for most younger people. And I include younger plus, I include most Gen Xs here. We need to find a way to cater to market segments, the affluent, the mass affluent, basically people that are beginning on the wealth journey now. We need to find a way to use technology to work, to provide our services at a lower price point. Not 0.25 has been bandied around. I would go even lower for certain market segments. There is a mass market out there, mass market in the millions in terms of the mass affluent out there. And we can work with all these people, and we don't need to send them all to the DIY tools. We can provide professional financial advice to these market segments as well.
So that's the difference, really, what you're talking about. We've got DIY tools, robo advisors, things like that, and then we've got wealth managers. And what we're saying is that the percentage is so low for DIY tools. I think it's about 2% globally, usage-wise. 98% of the world's wealth is with wealth managers, for sure. But how do we encourage? That's not the right word. How do we enable wealth managers to sort of target that market with a range of different price points?
The one word here is technology, and Invest, of course, is designed to be a key aspect of that technology. The intensity of what was called the traditional wealth management service, kind of, get somebody in the office, have a big shiny office, have a sharp edge suit and everything. It will stay, but it cannot be the only way that you deliver the service. In fact, you have to move into a multi-channel world where you have got, your traditional high net worth clients, ultra high net worth and all that, they might kind of still prefer the meeting in the boardroom, all the way to having an offering for younger clients, people that are just starting on the journey or lower portfolio sizes, that will primarily, if not exclusively, be serviced through a digital channel. You just need to make sure that there is a digital twin, to use a phrase, of your entire company on the digital domain. Not just anything that you do offline, on paper, in the office, whatever, you need to kind of be able to do online. Have a digital twin of your business, and all sorts of avenues open up for your customers.
Okay, great. So I've got my second reflection point here to the audience. How can your firm adapt its services and communication strategies to better appeal to younger investors? So just to leave that out there and leave that hanging. So what are the preferred methods for tracking investments among younger investors who do monitor their portfolios? What are your thoughts there, Theo? We've got some stats. I can run. Actually, I'll run through the stats and then we'll pick up afterwards. So the survey said that 26% are using self-investing apps. 12% use reports to track their investments, so PDFs, and 6% employ or use advisor client portals. How can sort of wealth managers better engage younger investors based on these findings, Theo?
Clearly, rebalancing the statistic over in favor of the client portal is the most important one, because once you have people's attention in the client portal and in the branded environment of your, the digital twin of your organization, then you can work with them a lot more. You can service them more deeply, more intensely. Mobile first experience is a must, has to provide an elegant, simplified experience in par with all the other financial services that you know. No matter how small a company you are, there is now no excuse for a clunky, outdated client portal or one that doesn't work on mobile. It simply isn't. Capturing a share of mind or a share of attention is a second task over there. So you do have the portal and everything. You need to use these nudges, these tools, these prompts, these notifications, these contact points, touch points, whatever you want to call them, to don't overdo it, but get a bit of attention, to get people engaged, to kind of get people more comfortable and to get people engaged to the level that they would be aware of what's going on with the portfolio and their investment targets, but not so much that they worry about it. And the third one that would include over here is to assume that the experience is going to be shared. And I'm going to the world of social a little bit over here, especially for younger generations, probably younger than Xers, but millennials, for example, they will share their experience of working with their financial advisor or wealth managers with their friends. It could be on social, it could be directly with their friends. So you need to strike a tone when you present yourself in social media that it is both professional but authentic. So in a way that you can be part of that conversation. I do caution against trying to emulate consumer tricks, trying to employ influencer language and the rest of it. It will not work, and there is no point for it to work. Professional but authentic is the best way I can describe how a financial services company should present themselves in the world of social.
Okay, great. Thank you, Theo. Now I've got a final reflection point here. What strategies have you and your teams found effective in engaging younger investors? So I'd be really interested to know from the audience, what works and what doesn't. And I think if we could share that in some way, that would be brilliant. Next question, I suppose. What implications, Theo, do our survey findings have for the future of wealth management? We've talked about a lot, but can you give us an overview or summary?
Yeah, I'll try to strike a more optimistic tone as we get to the end of the survey and the questions. Now, the survey itself overall paints a pessimistic picture. Yeah? We are not able to work as an industry with younger investors as well as we should. Some of them, they don't understand it, they're not engaged, they don't feel in control. All this negative feedback comes in for over half of those we talked about. Yet there is the other half, or just under, that are feeling a little bit better about working with financial advisors and wealth managers. So we need to kind of focus on what it is that we did right there and build on that. Now, the survey is actually a snapshot of the picture of the audience that's taken against an industry that it is in flux. That is, I mentioned in the very beginning that we're seeing the only constant is relentless change. And the bigger picture here is that over the last 2 decades, a lot of innovation in the industry has gone into disintermediating the intermediary, the financial advisors, the DIY technology, the investment apps, the embedded investments in the banking apps, all this technology that seems to want to elbow away professional advisors and wealth managers. And yet, the same technology is available to us as an industry, to the wealth management industry, and we can do a lot better. One of the tenets of in the tech world is that the holy grail here is to use technology to offer 80% of the service for 20% of the cost. If you can get to that, you can service a much wider audience. I'm talking about the affluent and mass affluent segment, which includes, of course, all the younger investors that are starting on the journey. They don't want the whole service. They don't want to come to your office and kind of drink your coffee. They want to engage primarily on digital, so 80% of the service, focusing on investments, focusing on investment advice. So not the frills, but the core investment advice. Can you do that at 20% of the cost using technology? We think that you can. This is why we build Invest in the way that we have.
So we're talking about scale, really, aren't we?
Absolutely. We're talking about scale, and we're talking about scalability as well. And the upshot here, of course, is that wealth managers can use the same technology to reclaim market share, to build on the customer loyalty, to gain traction with younger investors, and to place themselves very well for working with these younger investors as they inherit the wealth of the previous generations. Now's the time.
Okay, great. Thanks, Theo. So thanks very much. That sort of brings to the end the first part of the webinar. We've got Q&A after I do a quick recap. And if you've got any questions, put them in the chat and we'll pick up on them. We've got 2 or 3 questions that have been pre-sent, so I'll run through those if nothing appears. And thanks again, Theo, for your insights there. So recapping a few key points, there's a significant gap in comfort and engagement with wealth management among younger generations born after 1965. This lack of engagement is characterised by limited financial literacy, low savings or investment habits, and infrequent investment monitoring. High fees and a preference for self-management deter younger investors from seeking professional advice. Wealth managers can adapt their practices to meet the needs of younger investors through simplified language, financial literacy initiatives, digital-first approaches, coaching services, and of course, transparent fees. While males tend to be more comfortable with investment principles, something we didn't quite pick up on, Theo, but it was evident in the split. Both genders face similar challenges in controlling finances and seeking professional advice. And finally, to better engage investors, wealth managers can create a more inclusive and accessible wealth management landscape that addresses the sort of needs, the unique needs and challenges of younger generations. So that's the overview. That's the recap. Of course, there's the survey itself, which can be accessed on the link on the chat, and you'll find that on the invest.com website as well. I suppose attendee questions. We've not got anything coming through on the meeting chat. But if I just ask...
I will just jump in here. So we have 2 questions under the Q&A section.
Brilliant.
I guess the first one Theo already covered, but yeah, maybe Theo, if you can just briefly provide the summary and probably anything else that you can add regarding this first question would be great. Yeah.
I'm sorry, Paulina, which question?
Yeah, the first question is from Mario, how to attract younger generations in asset management services. So basically, we know that you already covered, but maybe you have something to add or give the short summary.
I'd go back to the 3 points because I think that is worth emphasizing, underlining, striking through in very, very stark terms, those 3. Awareness, complexity, price. They don't know about us, they're scared of our language, and they think we're too expensive. We need to work on all these 3 in tandem. We need to tell people that they have got access to professionals, helpful, friendly professionals, as we are. This industry has got amazing people with amazing people skills, right? Who sit down, if anybody has sat down with financial advisors, and they're really empathetic. We need to bring that across. We need to tell younger people that resource is available to them. When we do so, we should not be so quick to jump into numbers. There is a line of storytelling that can be a huge part of our discourse. You're here now. This is where you're trying to get to. what Adam mentioned, short-term goals, medium-term goals, life goals. Let's get you there. Let's see where you are now. What are the tools that are in your disposals, and let's get you to that outcome. And the third one is price point. Okay, now that I have told you that we have created a plan for you, here's what it will take. Here's what it will cost for a professional like me to run you through this the storyline. We need to be transparent about it. Here's what it will cost, but we also need to find a way to use primarily digital technology to do that at a lower cost. How we do that? In a word, scalability, to be able to work with a larger number of clients and to be able to provide 80% of the quality of the service at 20% of the price point. That's the promise of technology.
Yeah, okay, thank you so much. Then we have another question, the second one. Could younger generations be reluctant because they feel they may not be taken seriously by asset manager?
Yes, absolutely. And I have come across that attitude. I certainly have come across it all. And that is reflected on the fact that, of course, most of the assets or the investable assets are concentrated on older generations. So you have got lots of investment professionals who themselves tend to be of a particular age that would say, I'm going to focus on this market segment where all the assets under management, all the AUM is. I want to focus on that segment, and I can't really be bothered to kind of explain things in simpler terms in any other way. Absolutely, but we can change that. There is no reason to be condescending on people that are just starting on a journey. If anything, we have all been young. We just need to kind of cast our minds back, think about what life was like back then, and just think how thankful would we have been if we had access to that resource back then, or for those of us that did have, how thankful we are because we made that starting our investment journey earlier.
Yeah, thank you so much. And we have this short question. Can you explain further how you see wealth managers' digital twins, client experience, access, and service? If there anything you can add and talk more about this.
Yes. So digital twin, of course, is a very, very, it's an idea that's in some ways it starts in healthcare, where you have got yourself and you have got the digital twin, which is kind of a digital representation of your physical self, your body. And then when it comes to healthcare, when it comes things like medicine or procedures can actually be tried out first, and kind of diagnosis and action is better on your digital twin. And it is a similar way in a wealth management firm where you have got the firm, if you like, the offline firm, the actual the professional advisors, the operations, the brand, all these things, and they exist now, they have existed even in traditional firms. And then you've got a digital aspect or copy of that operation. The point here is that this only works if a twin is a true twin. That is to say that everything that you do, every operation, every brand touch point that you have got in an offline world, you replicate on the online world. Anything from onboarding all the way to your communication, your catch-up meetings, every brand touch point that you have got in the offline world needs to be available in the digital world. The second point is that what you can do with your digital twin is you can measure everything. So whereas it is not that easy to measure stuff in the offline world, once you have got a digital twin, you have got rich analytics. You have got rich data that you can measure and make decisions and understand better. Your single customer view. All these things are available much more easily, much more readily.
Can you give us an example, Theo, of how we might use insights and analytics to, understand our clients better? Give us a use case. What have you got?
Yeah, absolutely. One of my favorite things when it comes to analytics is kind of understanding the customer beyond the risk profile or beyond what a questionnaire of 10 questions will tell you about the risk appetite. typically when you board a client, you might kind of ask them 10 questions, 20 questions, 15 questions, whatever. And just say, based on these questions, based on what you told me just now, I'm going to give you a score of 3, and then I'm going to design a portfolio based on that. Having said that, as time goes by, somebody's risk profile changes, and also the way that they engage with you in a client portal or in an app might give you much richer statistics or understanding or insight about their actual risk profile. Let me put it another way. The risk profile of an individual is different based on what they do than what they say. And you can only ascertain that on your digital twin, on the analytics. And then based on that, you can obviously take action. If somebody is engaging in the portal or your app in a different way or in a way that is not in sync with what you think is the risk profile, it's time to take action.
Okay, great. Thanks very much. Are there any more questions on the chat, Polina?
Basically that's all for now, but yeah, feel free to.
Well, I've got one more thing for you, Theo, and I suppose it's just about. I mean, you've kind of answered it, but I just want a more sort of straightforward, succinct answer from you, not just so that for clarity. But how can wealth managers bridge the gap between traditional financial advice and digital first preferences of younger generations?
So how we close the gap with technology? Let's look into banking, how banking did it. At first, it was an offline, you had a branch, and then gradually you started doing more and more things onto the online world until, it kind of started being digital first. And then it became, as it is now, digital only. Now, we as an industry, as a wealth management industry, because we're an empathetic people industry, we're not going to go that far, and we shouldn't go that far. There is other apps that will do that. The DIY robo apps will do that for you. So we're not going to get rid of the in-person channel. What we are going to do is we're going to treat the in-person channel as one of multiple channels. And then gradually, as people come into, new customers come into our roster, we'll be working with younger generations. Some of them might just become single channel, digital only customers. Mm-hmm. Others will take advantage of both of them. So the gap will kind of close itself this way. We just have to make sure that we become, to borrow a term from the retail world, omni-channel. It's not just the in-person, just the digital one. It is all of them. You have to use all the channels, and then customers will use the one that they prefer.
Okay, great stuff. Thank you. Well, look, that brings us to the end of this webinar. I'd like to thank everyone who came along for the journey, and I really hope that it's been helpful. If you have any questions in the future, please reach out to us, and Polina will either directly on LinkedIn or something, or through Polina. I'm sure she'll be in touch, and we'll send a link over for the survey to everybody that hasn't received it, and we invite you all to come and have a demo with us and view Invest and see some of the things that we can do to bridge that gap between traditional advice and digital first preferences. So thank you very much. Thanks very much, everyone, for coming on board, and hopefully we'll see you next time.
Bye, everyone.
Bye, everyone.
Thank you. Bye-bye.